Across the country, something unreal is happening in the car market right now. Cars with barely a few thousand miles on them, models that sold out last year, are suddenly being unloaded for pennies on the dollar, dealers are slashing prices, rental fleets are dumping entire lineups, and auctions are overflowing with like-new vehicles that no manufacturer wants to talk about. This isn't a seasonal dip or a clever promotion. It's a system-wide unwind, driven by oversupply, collapsing resale values, and credit pressure that's starting to crack the industry from the inside out. And if you think this won't affect you, think again. Because the cars hitting the market today will reshape prices, loans, and trade-ins for everyone. From fleet fire sales to flooded EV lots, and the repo wave nobody saw coming. This is the story of how millions of nearly new cars are being dumped at the cheapest prices we've seen in over a decade, and what it means for your next move. Sticker shock in reverse. For years, the window sticker on a nearly new car was treated like a solid anchor, something you could nudge down through clever negotiation, but never something that simply collapsed in broad daylight. But in 2025, that anchor has snapped. Cars with only a few thousand miles, former demos, executive-driven units, short-term fleet vehicles, and even untouched new inventory are now resurfacing online at prices so low they look like placeholders. Dealers frame them as event specials or limited incentives, yet behind the scenes, they're calling it what it really is: liquidation under pressure. Floor plan loans are eating margins alive. Manufacturer allocations keep arriving based on outdated demand forecasts. And storage lots are filling faster than sales can clear them. Buyers sense the shift, too. The sudden pivot from last year's supply shortage to today's near desperation is unmistakable. Vehicles that once triggered bidding wars are now being pushed out below cost just to generate enough cash flow to stay afloat. Every dramatic markdown isn't a celebration for consumers. It's a distress flare from dealerships trying to outrun debt. And if that's the surface-level chaos, the data underneath paints an even more severe picture of what's really happening next. Proof of the flood. The numbers behind this collapse make the situation unmistakable. Wholesale auction reports from early 2025 show like-new vehicles, many with fewer than 5,000 miles, clearing for 20 to 40% below their advertised retail price, and a growing share even dipping under original factory invoice. Electric models, especially ex-rental and subscription fleets, are being hammered the hardest, with entire rows of them selling at prices that would have seemed impossible just 1 year ago. At the same time, dealer inventory levels keep climbing. Industry trackers estimate that low-mileage used stock is up by nearly a third compared to last spring, while retail sales have slowed to their weakest pace since 2011. That mismatch creates a punishing financial squeeze. Every extra week, a car sits unsold, piles more interest onto a dealer's floor plan loan, erasing profit before a buyer even walks in. Consumers feel the impact through collapsing trade-in values, inconsistent pricing, and listings that drop faster than pricing tools can refresh. This isn't a seasonal adjustment, it's a structural backlog born from years of aggressive production, meeting a buyer market that can no longer keep up. And to understand where this oversupply truly began, we have to rewind to the pandemic echo that set the stage for today's surplus. If you've already spotted similar price drops or liquidation listings in your area, hit like and drop a comment below. Every data point helps map how fast this market is unraveling. Pandemic echo and cheap money. To understand why millions of nearly new cars are now being dumped for pennies, you have to go back to the chaos of 2020. When factories shut down and supply chains froze, automakers panicked, then overcorrected. By late 2021, they were running overtime shifts, pouring billions into catching up on back orders while assuming demand would stay sky-high indefinitely. At the same time, cheap credit flooded the market. Stimulus checks, low interest rates, extended loan terms, and leasing incentives created a buying frenzy, unlike anything the industry had seen in over a decade. Fleets, rental companies, and subscription startups bought aggressively, believing that their usage models would remain permanently elevated. But when inflation surged and interest rates doubled, the entire structure buckled. Consumers who once stretched to afford new models suddenly stepped back, leaving dealerships holding vehicles financed at yesterday's optimism and today's costs. Yet factories kept producing based on outdated demand forecasts, funneling waves of inventory into a market that was quietly losing momentum. That misalignment created the surplus we're drowning in now, cars built for buyers who no longer exist at the same scale. And as automation and global supply chains carried the momentum forward, a new problem emerged. Fleets that once absorbed massive stockpiles were now getting ready to offload them all at once. Fleet fire sales. For years, fleet buyers acted as the industry's pressure valve, absorbing massive volumes of vehicles and keeping factories humming. But in 2025, that safety net has snapped. Rental giants, ride-share fleets, corporate lease programs, and failed car subscription startups are all dumping their nearly new inventory at the same time. Rows of low-mileage sedans, crossovers, and especially EVs are appearing at closed-door fleet auctions, many less than a year old, some with interiors that still smell new. These companies overbought during the rebound years, expecting business travel, tourism, and subscription demand to keep rising. Instead, higher operating costs, softening customer demand, and brutal financing terms have left them desperate to unload assets. Rental firms are slashing fleets to cut insurance and maintenance expenses. Rideshare operators are retreating from costly EV experiments. And subscription platforms that burned through investor money are liquidating everything they can. The result is a wave of vehicles hitting auctions faster than dealers can absorb them, forcing prices even lower. For everyday buyers, the shock comes later, when these units show up online at numbers that undercut traditional used cars overnight. And with fleets stepping back, the next source of supply shock is already rolling in before sunrise: repossessions. Repo row. Before the sun even rises, the next wave of supply is already being chained up and hauled away. Repossessions, once a background factor in the used car ecosystem, are now exploding across the country. Lenders report a sharp rise in delinquency rates on auto loans, written during the low-interest boom, especially those stretched to 72 or 84 months, with tiny down payments and inflated pandemic-era pricing. As rates climbed and trade-in values collapsed, thousands of owners suddenly found themselves upside down, owing far more than their cars are worth. Adjustable rate loans rolling from 3% to over 7% have pushed monthly payments beyond what many households can handle. Tow trucks, contracted by banks, quietly sweep through neighborhoods each morning, collecting vehicles that dealers aren't celebrating, but dreading. Every repossessed car dumps more low-mileage inventory into auctions, driving wholesale values down further and erasing margins on cars still sitting on lots. For current owners, the shock is personal. Cars bought 2 years ago for top dollar, now wholesale for a fraction of their payoff amount. The domino effect is brutal. Repos hit auctions, auctions hit prices, and prices hit every owner who thought their car was an asset. And even if you avoid the repossession wave, another danger lurks in the like-new cars that look perfect, but hide problems no dealership will explain: EV glut and tech whiplash. No segment of the market shows the collapse more clearly than electric vehicles. What was once the hottest, most future-proof corner of the industry has turned into a swirling oversupply that even major dealers can't digest. Over the last 2 years, rental fleets, ride-share operators, government programs, and corporate sustainability projects bought EVs in massive waves, often encouraged by tax credits, grants, and aggressive manufacturer incentives. But in 2025, the equation flipped. Battery degradation concerns, charging frustrations, high insurance costs, and rapidly changing technology have made last year's EVs feel outdated almost overnight. New models promise longer range, faster charging, and cheaper batteries, instantly pushing down the perceived value of units with barely 8,000 to 15,000 miles on them. Fleet operators, eager to cut losses, are unloading these EVs in batches of hundreds. flooding auctions with rows of identical vehicles. Dealers are taking them reluctantly, knowing they'll sit longer and depreciate faster than gas counterparts. Buyers scrolling through listings see the chaos in real time: massive price disparities, sudden drops of thousands of dollars, and like-new EVs listed cheaper than 3-year-old hybrids. The technology curve is moving faster than the market can absorb, and everything built before the newest breakthroughs is being sacrificed to clear space. And with so many EVs slipping through the cracks, the next risk is even more hidden: the condition behind those bargain tags. Like new or time bomb. In a market drowning in like new deals, not every shiny listing is the opportunity it appears to be. Many of the cars hitting the market now, whether ex-rental, ex-fleet, or barely used trade-ins, carry a history that gets conveniently blurred in the rush to liquidate vehicles that spent their short lives on rideshare duty, often show minimal miles but extreme wear. From fast charging abuse in EVs to stressed transmissions in gas models. Corporate fleet cars may have spotless exteriors yet hide skipped maintenance due to cost cutting. Even rental units that look clean on the lot may have endured hundreds of drivers, each treating the car like it wasn't theirs. Add in the growing number of lightly repaired insurance write-offs entering the used market through title-washing loopholes, and the risk becomes even clearer. Dealers aren't always upfront about the true usage cycle, especially when they're desperate to move metal before values drop further. Buyers jumping at bargain prices often overlook missing service records, inconsistent tire wear, or subtle signs of structural fatigue. A car that feels like a steal today can become a repair debt tomorrow. And even if you manage to dodge the hidden history trap, there's still another layer of manipulation waiting: the digital storefront, where all these cars compete for visibility, the listing trap. On the surface, online car marketplaces promise transparency and convenience. But in 2025, they've quietly transformed into pay-to-play arenas, where the best deals often stay buried. Major platforms now prioritize dealers who pay for boosted visibility, meaning two identical like-new cars can appear pages apart simply because one seller spent more on promotion credits. Algorithms track buyer behavior and adjust suggested prices upward, inflating expectations and masking the true collapse happening underneath private sellers. Without premium listings, find their ads pushed to the bottom within days, while desperate dealerships pay extra to hide their steepest losses behind featured placements. Meanwhile, automated pricing tools struggle to keep up with the rapid depreciation triggered by fleet dumps and repossessions, causing listings to swing thousands of dollars in a single refresh. For buyers, this turns the hunt for a fair price into a maze, where inflated ads dominate the first pages and the real bargains often never surface. Unless you dig through off-peak hours or wholesale-style sites, even seasoned shoppers end up chasing phantom deals that vanish once the algorithm re-ranks them. And with the online landscape distorting reality, the next question becomes critical. When is the exact moment to step in and buy before the market shifts again? Timing the collapse. In a market this chaotic, timing isn't just helpful, it's everything. The flood of nearly new cars hitting auctions and dealer lots doesn't spread evenly throughout the year, and understanding those cycles can make the difference between overpaying and walking away with a once-in-a-decade deal. Historically, the steepest drops hit during periods when dealers face the highest pressure from floor plan interest, late winter and early spring. But in 2025, the pattern is even sharper. Fleet liquidations spike at the end of each quarter as corporations close their books, while repossessions surge in the weeks following major rate resets. EV prices fall fastest right after new tech announcements, when older batteries instantly become yesterday's news. Add in the model year transition, when unsold new cars suddenly feel obsolete, and the opportunities grow even bigger. At wholesale auctions, winning bids during these windows run 15 to 25% below mid-year averages, and retail dealers quietly mirror those drops just to keep inventory moving. Buyers who track these rhythms, instead of jumping at the first discount they see, often capture deals others don't believe are real. But perfect timing means nothing without knowing what numbers actually matter. And for that, you need to see through the sticker to the truth underneath: reset or wreckage. The final phase of this collapse hinges on a single question. Is the car market heading toward a controlled reset or a full-on wreckage? Automakers are already scaling back production, but many of those cuts are symbolic. Small reductions meant to reassure investors, while factories continue pushing out vehicles that dealers can't absorb. Meanwhile, lenders are tightening credit standards, raising minimum scores, and shrinking approval windows, which limits how many buyers can even participate in the market. That choke point slows sales further and traps more inventory on lots, turning every unsold unit into another financial liability. Manufacturers face mounting pressure to protect resale values, yet they can't stop fleets and repos from flooding auctions with nearly new stock. The result is a system caught between needing to sell cars and needing to keep prices from deteriorating even more. Consumers sit at the center of this tension, watching values swing wildly from month to month as brands fight to stay afloat. If demand doesn't rebound soon, and if financing stays expensive, the market may shift from correction to collapse, forcing weaker automakers, struggling dealers, and over-leveraged buyers into the same downward spiral. And as that pressure builds, one message becomes clear: nobody can afford to ignore what happens next. The signs aren't subtle anymore. Millions of like-new cars are being dumped at prices the industry once swore were impossible, and every corner of the market, fleets, dealers, lenders, and even automakers, is scrambling to survive the fallout. What started as overconfidence during the pandemic has become a chain reaction of oversupply, tightening credit, collapsing resale values, and desperate liquidation moves playing out in real time. For buyers, this moment is both an opportunity and a warning. The wrong purchase can trap you in years of negative equity, while the right one can leverage the chaos to your advantage. But ignoring the shift is the only guaranteed way to lose. Stay alert, track the cycles, question the listings, and understand the pressure behind every special offer you see. Because in a market this volatile, your awareness is your greatest protection. If you want to stay ahead of the next wave and not become the buyer who pays for someone else's dump, make sure you're ready for what comes next.